Introduction. The start of stock. Stocks provide an attractive return for investors, so that stocks are one of the most popular investment instrument. Although stock make it possible for investors to get large returns, investors are also burdened with a large risk. As mentioned in investment law, high risk, high return. The higher the risk, the higher the return that will be obtained. Investors certainly aim to improve their welfare by expecting benefit to be obtained. In order not to buy the wrong shares, investors must be smart in assessing the company to which share will be purchased. And these are several things that investors should pay attention. The first is price to book value, because a high price to book value shows the quality and good performance of the company, so that it will make investors believe that the company's future prospects will be good and profitable. And then current ratio, because assessment of investor regarding the company's ability to pay off its debt. And then the firm size is important, because the tendency of people who they pay attention more to big company. And my research return is first research variable. The endogenous variable is price to book value, and the first exogenous variables is current ratio, and the second one is firm size. And I have several hypotheses here. And hypothesis from first exogenous variable is current ratio has a significant effect toward firm value, and current ratio has no significant effect on firm ratio, so as firm size. And the object of the research, I use propositive sampling. So there are three categories. The first categories is these are 22 agricultural companies listed on the Indonesia Stock Exchange for the 2015 to 2017 period. And the second category is there are company who reported one of the data from the current ratio total asset, but it's incomplete report. And the last categories are there are 16 companies that are completely reported current ratio, total asset, and price to book value. And here are my sample in this research. I use secondary data in the form of documentary data, such as previous research journals, literature, and company financial performance report. And using multiple regression analysis as a method of analysis, with two stages of testing, namely classical assumption test, especially normality test, multicollinearity test, and autocorrelation test. Then followed by hypothesis testing using a cons level of 0.05. After that, the still put simultaneous test or F test, and then determination coefficient test and partial test were carried out. And here is the definition of variable. The first is endogenous variable is market to book value or price to book value is one of the indicator for evaluating investors in assessing a company. This ratio compares the share price per share to the book value of equity per share. The greater the value of this ratio, the better the company's performance. Based on Nurhayati, 2008. This ratio is calculated using the formula as below. And then in exogenous variables, the first is company size. Here I given the company size with size symbol. This variable is measured using the natural logarithm of book value of assets. And the second exogenous variables is company liquidity. Current ratio is one of the alternative of the company's liquidity ratio. This ratio measures the ability of the company's current asset to pay the company's current liabilities. Suppose that the current ratio of the company are converted into company cash to be used to pay off their current liabilities. And the current ratio formula is stated as below. And then this is the result and discussion. The first is normality test, and I got a table here. And the table show that the significance to talent has 0, and then it mean the data is not normal. It is necessary to transport the data with natural logarithm. And here is the result after the data transformation with natural logarithm. I got 0.169. So it means 0.169 is greater than 0.05, which indicates the data has been normally distributed. And then next is multicollinear test after transformation. The tolerance independent variable is 0.970, which is greater than 0.10, where the VIF value is of both is 10031 is smaller than 10. The referring to the basis data decision making in the multicollinearity test, it can be concluded that multicollinearity does not occur. And here is autocorrelation result. We got 2.235, where in Darwin-Watson table for K3 and 16, the Dewey table says is DL is 0.857 and DU is 1.728. And then for mean DL is 3.143, and for mean DU is 2.272. The wave value is between DU and DL. It means there is no autocorrelation. And here is the result of simultaneous test. Uh, the table shows the result of both independent variables have a significant effect on the dependent variable. The table above shows Fcon of 12.480 with a probability of 0%. This proves that the current ratio and company size have an effect on the price to book value. And then there is a partial test result based on the result in the table. Multiple linear regression obtained as follows. Uh, Lon PBP equal 2.113 as a constant and plus 0.450 CR and 1.527 size. From the equation, it can be explained that a constant of 2.113 states that if LNCR and LN size are 0, then LNPBP is 2.113. The regression coefficient for the LNCR variable is 0.450, meaning that if the independent variable are fixed in value and LNCR increased by 1%, then LNVBP will increase by 0.5, 0.40, 0.450. The coefficient is positive, meaning that there is a positive relationship between LNCR and LNVBP. The higher the LNCR, the higher the LNVBP. The regression coefficient for the LN size variable is minus 1.527, meaning that if the independent variable are fixed in value and Ln size has increased by 1%, then Ln VBP will experience a decrease of minus 1.527. The coefficient is negative, meaning that there is a negative relationship between Ln size and Ln VBP. The higher Ln size, the lower the Ln VBP. And here is the hypothesis result. For current ratio, HO is there is no significant effect between LNCR and LNVBP. HA is there is a significant effect between LNCR and LNVBP using a significant level of 0.05 per 2 equal 0.025 with degrees of freedom df and k min 1 or 19 or 16 mean 3 mean 1 is 2. So that the T table is known to be 2.179 based on the output in the table 8. It shows the T value of 4.978. The decision making criteria are T count smaller than T table, then HO is achieved. And if T count is greater than T table, then HO is rejected. Because the value of T count is greater than T table, it can be concluded that the current ratio has a significant effect on the price to book value. And the firm size to price to book value hypothesis are there is no significant HO is there is no significant effect between LN size and LN VBP, and HA is there is a significant influence between LN size and LN VBP. Using a significant level of 0.05 per 2 is 0.025 with degrees of freedom df and k mean 1 or 16 mean 3 mean 1 is 12. So the table is known to be 2.179 based on the output in table 8 is known the t value of mean 1.292. The decision making criteria are t count is smaller than t table, then how is achieved. And if t count is greater than t table, then how is rejected. Because the value of t count is smaller than t table, it can be concluded that the company size has no significant effect on the price to book value. And the conclusion is uh, current ratio from the test result have a positive and significant effect on the dependent variable, namely price to book value. Uh, the implication is that when CR increase, VBP will be increased too. And company size based on the test result has a negative and insignificant effect on the stock price. The implication when the size increases, the stock will be decreased. Thank you.